Hi, welcome friends. So, this is related to a recent announcement which you may have heard about Franklin Templeton debt schemes. They recently closed six of their debt schemes on 23rd of April, and which is a big buzz in this industry. Everybody is talking about this Franklin Templeton new shutdown announcement. Some feel that it is a fraud. Some feels that, and they are worried about their money, which they believe will never come back. And there are n number of different discussions which are going around related to this specific issue. But we thought that why not present an educative insight to the whole issue so that you should be able to take an informed decision about if you are invested in a Franklin Templeton funds. And also, this whole presentation will give you a confidence about one thing which we always say related to mutual fund, that mutual fund is the safest structured product on this universe. So that's the basic crux under which I'm going to present this whole session. And friends, let I will explain everything what happened in Franklin Templeton recent announcement and scheme close down. So do watch the video till end because it is going to give you a lot of insight about good investing and how to select funds also, and you will learn almost everything about a debt fund. So let me take you quickly through these whole action. And as you know, what the action is, that Franklin Templeton Mutual Fund has closed down its 26 debt schemes, and the announcement was made on 23rd night, and 24th April it became effective. Six schemes, friends, closed. And so basically, friends, we have to talk about few things which comes from the statement only. You see, Franklin Templeton has closed, so we have to understand about Franklin Templeton. So that's key thing. Secondly, it's closed down its scheme. So closed down, what is the word closed down and what happens? So we have to understand what does it mean by closed down. And its six debt schemes has been closed down. So you have to understand the distinction between debt schemes and equity schemes. So what is the difference between both these kind of schemes? So you have to understand this whole concept, and that's the way we are going to take you towards this whole discussion. So when you are listening to this whole presentation, be sure that we are the guys who are related to mutual funds from the ground level, in and out. So whatever we are talking on a very, very logical and sensible manner. So I'm sure it will help you. So friends, when we are talking about Franklin Templeton, it is must to understand because Franklin has announced this. So you must have to check some credibility about it. Who is Franklin and what they do? So this picture in itself gives everything about Franklin. No doubt about the trust, the stability, the experience, expertise, everything is there. So research offices, global trading offices, different countries, they are present across world, and their local asset management team is also very, very large. So you can't just expect a company like this to do something which is not in the interest of investors. So this gives a background, this gives a confidence to the viewer who are going to watch my video. So that gives you confidence that you are talking about someone who is really established, ethical, and one of the greatest financial institution in this world. So, dosto, when we are talking about Franklin Templeton India, that also is not 1 or 2 months old. It is basically here since 2 decades and more than 2 decades, and so they have their offices in different parts of India. So now the second thing, the key thing you have to understand about mutual fund. The mutual fund, the Franklin Templeton Mutual Fund, which has announced this sudden close down, you have to understand basically in what kind of structure these mutual funds are available and to the customers, and what is its basic definition, roles, duties, and responsibilities. So let me talk about it one by one. First of all, you have to understand that mutual fund is just a vehicle to reach various issuers of investment products. It's not a product in itself. Basically, it's an intermediary, a kind of intermediary. You give them the money and they invest in the product which you have asked them to do so. So there are different options available under which they offer their investment management. We have to give them according to, hey, take this money and go and invest in pharma fund. Hey, take this money and go and invest in bank fixed deposits and bonds. Hey, take this money and go and invest in all large cap funds. So that's the way customer gives mandate, and that mandate is called investment objective. So mutual fund is nothing but just a vehicle to take this, and in return they charge some percentage of fees which is capped by SEBI and managed by SEBI, maybe in the tune of 1.5% to 2%, but that is again regulated by SEBI, the Security Exchange Board of India. So that's the reason, friends, I say claim that mutual funds are the best and the safest product across world, because here no one is owner. You and me are the owner of the fund. So you cannot run away with your money. So the biggest safety in mutual fund is that no one can run away with your money, because every unit holder is the owner in that product. Now, so what bad can happen? Yes, the fund management can go bad. The manager may take wrong route or do wrong management. So that can happen. Your mutual fund product can deliver better return or a poor return. So that is something else. But on a credit side, on a structure side, it is completely safe. So that's what I was trying to explain you. Secondly, whenever this vehicle is launched, it's just like a bus. Imagine there is a bus and there is a station. There are n number of buses standing there. Some bus is going to, say, on the hilly range, Kurg, or say example Munnar or somewhere, and there are some buses going to the plain area, like maybe on a Gorakhpur or Lucknow or somewhere. So whenever they launch, they tell you the objective and destination. It's written on the bus clearly. Every customer has to choose according to their own information and knowledge about the destination. For example, if you don't know how and what kind of weather will be there in Lucknow, and you just onboarded this bus which was going to Lucknow, so you may find it difficult to really reach. After reaching Lucknow, you may find it difficult to cope up with the heat or the area. So this can be a problem to you. So what we suggest is, and there where advisor like us or consultant like us comes into picture, we explain you the basic destination features. What could you expect by going there? What could be the journey like? Maybe it's a tough journey. It's a turning road. It's a bumpy road or something like that. So that's all you discuss with your consultant, and finally either enter through a NFO, or if it is a open-ended, you can even come any day. So you can onboard the bus at the station also, or en route also. So that's called open-ended, and you can get down the bus anytime as when you wish. But in close-ended, you can onboard at one time only when there was an offer. But if you want to get down, you have to call someone else to take your seat, because you cannot just leave the seat and get down. So that's close ended. So as you understood, open ended, you can get down anytime. The fund manager or the fund owner, I cannot say owner, the fund manager and the fund house buys your unit back. So the fund buys your unit back and gives you the money, and you get down the bus. You are not required to bring someone else to take your seat. But in close ended, you are required to bring someone else to sit in your place. You cannot leave it empty. So that's why you have to go to stock exchange and sell your unit to someone else, because fund is not going to buy your units. So that's the basic difference, friends, open ended and close ended. And once you understood, let's go back to the basics and then see what are the roles and duties and responsibilities of a mutual fund. So the first role is to identify and invest in good financial products as per the scheme objective and mandate provided by the investors. You have to, a mutual fund is supposed to identify these products which are good. They should analyze it, they should study about it, and they should really understand that what they should expect at the destination. So because of that expectations, and accordingly they create a mandate, and then investors read those mandate. If they like it, they finally invest into it. Now, the second duty is when their duty is towards the trust. And what is trust? In mutual funds in India is formed as a trust because each unit holder is the owner. So all these owners together is being represented by a trust, which is an independent body and which is something like a police inspector, a full-time inspector to as a watchdog for the AMC. This trust ensures that the money of all the investors are safe in that terms. It is invested as per the basic objective. All the profits are distributed properly, all the losses are also being distributed properly, there is a correct valuation process, and they do every good practices. For example, if you take the example of a bus, so the driver is the AMC who is driving the bus, and the trustee is the traffic police, and who is looking at it and ensuring that everything is going right. They are not crossing the red light and green light, and they are doing and driving according to the basic law of the roads. So that's all what trust do. And the passengers who are sitting inside the bus are basically the unit holders. So, and the third is its responsibility is to abide by all the regulatory norms of investment management as laid down by SEBI. So that is again a very important responsibility of AMC. They should do everything in accordance with the regulations which are laid down by SEBI for mutual funds. So they do that, and that's the scenario which can create just a mock-up which I have created for your basic understanding. And as I said during the video that we are not going straight away to jump on Franklin issue. Before that, I'm taking 10-15 minutes to give you a detail about what is a mutual fund and how it is structured, so that you can get to understand that problem easily. So friends, this mutual fund vehicle, which is a mock-up of what mutual fund is, you see, these are the investors as I just shown you. These are the investors and sitting in the bus. This is an entry door and this is an exit door. So you see entry door and an exit door. And here we have a driver and whom we call a fund manager and AMC. So this fund manager and AMC has a basic job of taking everybody to the destination safely, properly, and as per the given mandate. So there can be different mandate. Maybe the driver will say, hey, the route is like this. I will drive slowly, but I will reach here. And there may be another driver who will say, hey, there will be bumpy road, but I will drive fast. So don't worry, keep your seatbelt tight and remain stayed. Don't hesitate. And I will certainly take you the destination faster. And once you reach there, you will enjoy it. So it's your choice, and this is generally, friends, called equity journey. When you invest in equity funds or participate in corporate companies' shares. So such funds have a bumpy road, but the overall return over a period of time is obviously higher. But if you choose a smooth road where no bumps, no hiccups, so obviously your journey will be a delayed journey. You will earn equal to bank rate or say something 7-8%. So obviously the person who needs a higher return need to face this what you call tough journey, but in which technical language we call it volatility. So you have to face this volatility. But if you don't want that volatility, obviously you will take a safer route, but then you have to compromise on the lesser return. So friends, that's how a mutual fund operates. All the journey is decided, transparent, and you, before sitting in the bus, should know exactly what kind of journey you are going to take. So that will give you confidence and patience also throughout the route. This is the key question here: what Franklin has done. So we have to understand, while driving their bus, did they meet any accident? So that's the key question. Uh, they took the bus to the wrong lane or kidnapped the travelers? Or have they changed the destination objective? Instead of taking us to Munnar, they diverted the bus towards Lucknow or Delhi. So is that so? Is there any such case? So we have to really drill it down to before really making our conclusion whether this action is a bad action or a good action. So friends, let's first understand what Franklin has done. No, they have not met any accident. So that's not true. The bus was running well, it is running well, still it is running. It is still running, friends. So, first, note down this statement I am saying: the bus is still running well. Now, they took the bus to the wrong lane? No, not at all. The bus, as I said, is running in the right lane. Whatever declared, wherever they were supposed to go, they are going. No kidnapping of the travelers. Have they changed the destination objective? No, not at all. Not at all. The objective was to invest in good debt funds, means products as a lending. They were actually lending to the companies, corporates, government bonds, everything. So there were six different objectives, but one key objective of the fund was credit risk. So there was one fund among all these six names which was named as credit risk fund, under which the mandate was clear that they want to have a credit risk. They want to have a risky lending to garner higher return. So I will come on that. But first of all, nothing has changed. Objective is same as it was. So what have they done? Nothing. They just announced that the bus will not pick any new traveler with immediate effect. So no one can come in and no one can go out. So that's the basic difference. So that's the announcement they have done. And as you say, not pick any traveler with immediate effect. They announced that the bus will not stop in between. So finally, it will deboard according to the stations which will get matured, and everybody will get their ticket reimbursement in proportionate manner. For example, once you reach a destination or one product of theirs get matured, they will return the money. Then again they will return the money when they get redemptions from time to time. So they have the journey, for example, A to B, and have different products. And say example, it's a 3-year product. So when the portfolio has a 3-year product, so A to B journey will finish in 3 years. So for that particular product they will return money in 3 years. So that's the way they will announce all their different portfolio products they have. That's called average maturity. And friends, it's very important for you to understand the average maturity concept here. So each fund, when you invest in a debt fund, this is called, and it's advisable for every investor to align their tenure, their investment tenure, along with the fund's average maturity tenure. So that is also a lesson here, that whenever you invest and you think that your destination or your average tenure is say 3 years, so you should not invest in a fund whose average maturity is say 10 years or 11 years. For example, let me show you something here just to give you an insight. So as you see here, it's a fund category across all the industry. Let me sort it out with 1 year return. As you see here, uh, there are different schemes under this mutual fund industry, and it's all debt, debt long term, debt short term, and different categories are here. So that's the way you see there are different debt funds. For example, you click here, debt long duration, and let me check any of the long duration fund here. Let me click ICICI Prudential uh, long term bond. So as I clicked here, and you will get to know that this fund has an average maturity. Let me check here. uh, I'll scroll down. Yeah, see, so this is modified duration, it's 7.6, and average maturity 11.4. So if anyone is investing in this fund who has a tenure not more than 1 year, or who is investing for a shorter term, is not advisable, because otherwise you will get trapped in this interest rate volatility chart. So as a long term, if you see, this fund has done well, really nice, because it has beaten the normal benchmark also, and giving you more than the bank deposit rate. Last 3 year or 10 year return, you see 8.4 something. So it's good. You have got something which is uh, in capital gain also, and also a return higher than the normal fixed deposits over a period of time. So not at all a big issue. You can really make your money as desired if you align your longer tenure, or the tenure of the fund along with your tenure. So that's very important in case of debt funds. Otherwise, if you have a shorter tenure and you invested your money in a longer tenure fund, so there will be a mismatch like you see here. There is a drop in interest rate, rise in interest rate, and drop in the prices. So you may get trapped here. So that's what I wanted to really focus upon. As you see, the portfolios here are all good AAA rated, fantastic investments done, and they have lended to like government security, or even say good AAA rated companies. So you have to have almost, say, not exactly 11 years, but at least 7 years or 6 years in hand. So that's the way you will really reap the advantage which is shown here in the graph as a total return. So these are the few things you should get educated, and you should discuss with people like us when you are investing or selecting a debt fund. So that's what I wanted to mention in this slide. Let's go back and see. As I said, these are the three things you should really understand, and that's what Franklin has done. And they will manage to return the money according to different tenures of their product which they have closed down. The average maturity is something which you should really wait for. Maybe in a ultra short you will get your money back in 3 months, or in a long term like their credit risk or other funds, you may get your money returned in 2 years or 3 years. So they have already released their chart of product maturity, and accordingly they have announced openly to the audience that what is going to be their frequency in terms of money return. So, what is bad in this whole scenario? So, as a traveler, I was sitting in the bus expecting it to take me to, say, example, Mumbai, but now it is saying that I will drop you maybe before Mumbai because I'm not running this bus anymore. So, maybe you will get your money back, and your long term destination will not be met. Secondly, they are saying that you have to change your bus once it reaches Delhi, because then money will come to you and you have to reinvest it. So instead of you're waiting and what you call accomplishing your basic objective, you will get money back. So that's going to be bad for a traveler. They have to now again select a different kind of funds or find the different avenue, and there may be the reinvestment risk which may come into factor, because say example, when the bus will reach Delhi, they will return all your money after say 1 year or 2 years, and interest rate in then in that context may not be so attractive. Like for example, you got your money back at a 8 or 9% yield, and you have to invest those money at 2% papers which are available. So that may be the bad day for you. But still, you are going to get your money with full charge, full return. And secondly, last thing which is very important here to be mentioned, that although you know that this bus is not going to really reach the longer destination, and you know that you have to get out of it by force, but you cannot opt it on your own. So my fears and apprehension as a financial consultant and advisor here is why the driver has announced this winding up of this journey. So this is a very key question. My second question is, and which comes to my mind, that is the road ahead really risky and dangerous? Because that is going, this question will actually give you an answer that whether you will be staying in other similar bus or you should leave all such bus. Because if the road is bad, if the road ahead is not good, because that's the signal which Franklin has given to all the industry people, that friends, I don't believe that the road ahead is good. So this is a key question, and we have to understand that can the driver actually who is driving similar buses in different companies, so will all they be dropping us at Delhi, or will it reach to the destination? Because if road is bad, it is bad for everybody. So that's something which is coming to my mind as a apprehension, and which needs to be answered. Now, the fourth point is, will I get the full value of my ticket? Because, say, example, today I am closed and the scheme is now wind out. So, will they return me the fair value? So, yes, there comes the mutual fund where I always say that mutual fund is owned by the unit holders. They get all the profit, all the loss, but it is all yours. No one else can take your money. So if the fund has invested in something which is going to pay them 12% in 2 years or 10% in 3 years or whatever be, so that is all yours. So don't worry about it. You will get exact value for your ticket as they are going to get it from the borrowers back. So that is not a big thing, but that apprehension is answered because of regulatory stiffness. And obviously, my fifth basic query is, will there be fair distribution of ticket reimbursement? Yes. So again, it's all mutual funds, and that SEBI regulations, distribution policy, and all those things give you no concern. So these two things are not at all a major fear or concern to me, because that is well taken care by the regulatory structure of a mutual fund. So only thing which I'm concerned about, should I really be staying in other similar buses which are running on the same route? Okay. In order to give you again some confidence about the maturity profile where you are stuck up, say example you are a Franklin Templeton debt fund investors, and these six funds where your money is logged have an average maturity of around 6 months for their close to 17% of their portfolio. So around 17 to 18% of their portfolio is going to mature in next 6 months. So they will return the that portion in 6 months. Then there is 6 to 12 months, it's around 8%. And if you go by these all charts, you see that in 36 months it's 19, in 60 months it's 12. So these are the figures which are being openly published by them. You can see and view in anywhere, like in their fact sheet or even in their basic circulation. So one thing for sure, that your money is going to be returned in different stages and as and when they get. But this is one thing which I would like to explain here, that's called put option. So these are the longer periods when their funds are going to get mature whom they have lended, but that does not mean you have to wait till so long, because they can exercise put option in those bonds, and under that they can get money even before maturity. So these are the schemes where their average maturity is being mentioned here and the total amount is also mentioned here. The only situation where I have a worry is a Franklin India Credit Risk Fund. So not, my worry is, again as I said, is not about the money return or a distribution, but my worry is, should I really exit from all the credit risk funds? So that is the biggest question here. Is this all about the route or the driver? As I said, I fully agree there is a problem in route, not in the driver, because Franklin Templeton is an established brand, and as I explained you in the beginning of this session, that driver, I think there is no doubt that, and I have my full trust on this, and because they have different schemes, they are established players, they know how to drive the bus, and no question about it. So the only problem is the route. So as far as their step is concerned, they are the best and experienced driver, and I think that today we should really focus on the problem, which is related to the route, because that will again conclude in terms of my suggestion, that what as an investor you should really act or really look at. So is there an advanced signal? Yes, that's what is the takeaway of the whole session. There is an advanced signal for the route, and I assume that if such a good fund house has got such a anticipated problem, so it is more about the route, and we should really think about changing all the buses which are running on that route. So their anticipation has to be respected. They have changed the strategy, which is very good. I believe that they had the best option which they exercised, because otherwise people who would have been sitting in the bus may had got a major accident, or they may also would lose on their capital, because if they would not have closed the doors, people who are redeeming, like corporates, large investors, HNIs, because of liquidity, they would really leave the remaining investors in a loss making scenario. So now let us learn something about the journey, because that is very important. once you understand that the buses which are running in our mutual fund industries are the debt fund, they are equity funds, and they are hybrid funds. So what is a debt fund? Basically, when you aim to travel on a smoother road and want your objective is close to fixed deposit rates, then you actually choose a debt fund. So here your return is secondary, but your safety is the primary thing. So you generally want a smoother ride, so you will get a lower returns close to bank. But there are humpy roads or maybe a very distorted routes, but the speed is very high. So those who are able to absorb this kind of road or this kind of volatility, which we say, they only go for equity because their aim is to return maximize their return. So that is the key objective. So that's why you are ready to take adventurous and tough routes. So equity is very clearly, it's if you want to reach Everest, you have to take that kind of tough route. And hybrid is a mix of both debt and equity, where we rely on a fund manager who could really manage sometimes, and when they see opportunities to run away from a tough route to a smooth route, and again come back from a smooth route to tough route. So that's the way these debt hybrid funds perform. They have some portion in debt, some in equity, and they keep changing their allocation dynamically. So Franklin, as far as concerned, has got a debt fund category, and there are different kind of debt funds under their category. So we are currently obviously not talking about equity. Nothing happened there. Hybrid is also not a discussion point here. We are talking about the debt funds where they lended to people, and those lendings which they have done, they doubt that there can be a smooth liquidity process in days to come. So that's the reason Franklin, if you see, they have lot many debt funds. They have not closed all. They have closed only a few six debt funds where they believe that redemptions pressure were high. People were jumping off the bus in anticipation or in case of liquidity. So nobody was jumping from the bus because fund was not performing well. They were jumping because they needed money. So in order to stop that sudden jump from the bus, they took this tough step. As far as equity is concerned, they have huge range of equity doing very well. And you see, there is one fund, US Opportunity Fund also, which is again delivering fantastic return in this crisis also. So as I said, in hybrid category or in equity category, there is no question. We don't want to really talk about that. So you should not conclude any such scenario that if there is a suspension in few of the schemes, that means Franklin is bad. So that was the point I wanted to make here, that they have suspended funds, but in your favor, for your safety, because they wanted that my existing investors should not get affected, or the people who remain in the fund should not get affected because of other people who are redeeming from the funds. And as you know, it's a very simple scenario. When you really invest or lend to someone, you lend for a tenure. So that tenure you have to really wait for to reap your profit. But unfortunately, because of liquidity demand, many people are now redeeming, and because of those redemptions, they are getting such pressure. And in order to manage that pressure, they close down their schemes. So as we say, mutual funds are the safest route to invest. Yes, I still claim the same with thumping hands and with all the confidence that overall in this whole universe, mutual funds are the best and the safest route. And when I say safety, I obviously mean that they are well regulated and by SEBI, as you know, Security Exchange Board of India, and that's why they are structurally safe. All the unit holders are the owner, and so no owner can run away with their own money. So in this scenario, when we talk about mutual funds, it's very clear in their objective. They are just the vehicle. They announce different objectives, like some bus is going to Himachal, some bus is going to Lucknow, some is going to Mumbai. You have to choose your objectives, which kind of route you are comfortable with. And as you know, in my previous slides, I have presented that there are different routes for all the destinations. Some are bumpy, some are smooth, and accordingly, they do whatever do is a transparent action. That's called daily NAV. So its transparency does not should not be really be a factor to keep you away from mutual fund. Rather, transparency is something which should push you into mutual funds. just because this is the most positive factor, most positive feature of mutual fund. At least you know every day that what is happening. But transparency should not mean that you get feared in terms of low NAV, or sometimes you get greedy when NAV is running, because you have to focus on your objective. You have to focus on your basic destination and tenure. In between, if you have chosen equity fund, there would be volatility route. If you have chosen debt funds, there may be a smoother ride, but change in interest rate can be adjusted in between. So you have to stick to your plans. That's the basic thing I want to present here. And friends, as an investor, I really believe that in mutual funds, the fourth most important factor here is the decisive and learned managers who act on your behalf, and in just few 1 to 1.5% of the fees annually, you are actually hiring talented, learned, experienced fund managers to manage your portfolio. So that's really, really cool thing here. And as I said, that my final suggestion is that you should get down from all such buses which are going and running on this route, which route is called credit risk funds. And what is credit risk fund? It's simple that in the word itself it's written that fund manager will take risk. They will invest in double A minus or lower graded papers to generate higher returns. So, but in this COVID crisis situation, it's not working well on liquidity front. So we are suggesting you to leave all credit risk funds. But as a disclaimer, I must tell you that mutual fund is subject to market risk, and you must read all the offer documents or ask us for details about different risk involved in different kind of schemes, and accordingly select your product which you really want to invest in. So that's very important. And for example, you see how to apply this kind of information is, say you are investing in a mutual fund and you have a different objective. So there are different products, as I said. Say example, you are going from a destination A to destination B. You have multiple routes to choose. And say example, there is a route which is a smoother road, no bumpy or no breakers in between, so it's a low risk product. There may be a medium risk product which is like this. There can be a road like this, and it is going to be, say, high risk product, or this is very high risk product. So there are SEBI defined stamping to each of the schemes which are under low, moderate, moderately high, and very high. So accordingly, you should first look at the route, because that will give you a confidence. Because say example, you have to reach a destination faster, you have to take a tough route. But if you have time in your hand and no requirement, you want to go slow, then you go for a conservative route. So that all depends upon the discussion when you do give us your objective of investments, discuss about tenure. We come out with a different proposition of schemes according to the risk factors. And obviously, when I'm talking about risk, it's all about market risk. Now, the views and analysis, as I said, is completely mine. And when I'm doing that, it's I take onus of whatever I'm saying. But again, the figures, discussions, and whatever is done, it is meant for my private customers, and it is only for private circulation. So this is not a public announcement which I am making. So it is only for my customers whom I am handling. This is a personal webinar. So this is again to be treated as a private view. And this webinar should not be treated as a suggestion to buy or sell anything straight away from here, because this is not a complete risk profiling tool. It is just a common analysis of an event which has happened, and I have added some educative value to it so that you take very informed decision whenever you are looking at your portfolio or you are worried about your investments. So that's the way, friends, and it's all from my side. Do contact us. These are the numbers which are available for you, and you can call me freely anytime. And also do visit my website whenever you feel like getting more details about your portfolios and investments.